Let's go ahead and get things started. Good afternoon, everyone, and welcome. We're glad you're here. I'm Randy Salser with Nacuso, and I'll be your host today. Thank you for taking the time to join us for our webinar, When Insurance Breaks the Loan. Insurance continues to be one of the most strategic and often under-leveraged member value opportunities in our industry. Today's about thinking differently about that opportunity. I'm excited to announce our presenter. Dan Daggett is what I call a true entrepreneur, someone who builds from within. Over more than 3 decades, his passion for innovation has resulted in entirely new business lines, new revenue streams, and more engaged teams. And not in theory, in practice. Dan has successfully launched 3 standalone business lines that not only increased his organization's income, but also meaningfully improve the lives of the consumers they served. That balanced growth with purpose is rare. And while I personally appreciate Dan's leadership style, is that he combines operational depth with big picture thinking. He understands how things work, but also continues to push towards what's next. At the center of it all is partnership and collaboration. I can tell you from personal experience, creating value for organizations while also strengthening the broader industry. Dan's passion is building something new and helping organizations move to the next level of success. And that's exactly what today's conversation is all about. So, Dan, we're grateful you're here, my friend, and the floor is all yours.
Great. Well, I appreciate that. Really appreciate the opportunity with Nacuso as well. It's been a very strong partnership for our team, both in our current CUSO as well as CUSOs in the past. It's just an organization that we really feel hits the collaborative vibe of credit unions and what we're doing. So we're very honored to be presenting today. 3 decades, how did that happen? When you think about it yourself, it says something, but when you hear someone else say it, it really has some meaning. So just want to say thank you to everyone that's here. If during the course of the presentation you'd have any questions, just go ahead and raise your hand in the chat. My colleague Emily is assisting me today, and she'll be able to kind of hit the pause button with me, and we can get some clarification there. So I hate this to be death by PowerPoint. But I'm going to go through a PowerPoint presentation with you and hopefully share some insight that you may or may not have known existed in the past. So with that, we will get started, and I'll share my screen. Can everyone see my screen? Okay, great. So as Randy alluded to, when insurance breaks the loan, rethinking collateral protection in an era of rising premiums. So I'll just jump right into it. So how are credit unions managing uninsured collateral losses? And we're going to talk a little bit about the status of the economy for the first few slides, just to set the stage for the solutions and how our current environment is impacting our credit unions. These slides come on behalf of Hub Financial, so they're pretty good statistical breakdown of where we are in the consumer insurance market, particularly when it comes to automobiles. So interestingly enough, in today's market, 14% of drivers do not have insurance. And perhaps just as important, that doesn't include the underinsured. So, they may have liability insurance or comp and collision, but perhaps not the limits that the credit union or the finance company needs in order to secure the loan. So that's something to take into mind as well. But that 14% of uninsured drivers equates to just under 36 million people on the road. Highest uninsured states, Washington, D.C., where Randy and I will be next week. Fortunately, I'm not driving because they've got 25% uninsured. New Mexico's 25%, Mississippi 22%, Tennessee and Michigan around 20%. My recommendation is if you're on the road and you're pulling up onto a vehicle and you see they have one of these license plates, you might want to give them a wide berth because chances are they might not have insurance. What's causing increases in uninsurability? We're looking at the price of auto insurance right now in this slide. In 2023, the average increase in auto insurance was 31%. 2024, it went up 15%, and it was projected to be 7.5% in 2025, and I didn't have the opportunity to validate what it actually was. But if you add those numbers up, it's around a 50% increase in the last 3 years. And for a lot of consumers, that's just unaffordable. And when they get into a hardship, chances are they're going to let their insurance lapse. we're going to look at some of the higher rates according to state. Minnesota during 2024 had a 58% increase in auto insurance, 53% in Maryland, 48% California, 38% in Pennsylvania, and 33% in Virginia. If you happen to be lending in those states, chances are your members, their finances are being pushed with insurance. And just a little bit about the average auto insurance premiums. On a national basis, $2,638 in the Houston market. Hub happens to be down in that Texas market, was $2,713. Florida was a high with $4,171. In Louisiana, just under $4. In Hawaii was the lowest, which actually I thought was surprising, knowing where the economy tends to be in Hawaii. And what's causing the increase? We're looking at this from a consumer or a member standpoint, but everyone on this call, we're consumers and we're members of the credit union as well. So we're also feeling these same pain points. Just general inflation, the increased cost of vehicles, repair cost, labor and parts. Some of the claims that we see, they've almost doubled, and it's just based on that labor cost and parts. An increased severity. We're seeing a lot more claims come in based on that increase in uninsured. Climate and weather event or climate change and weather events, whether it's hurricanes on the Gulf Coast or on the East Coast, hailstorms, tornadoes, all of those things just seem to be increasing. And when those hit markets, those losses get spread amongst all of us, which is why we all see an increase in those insurances. And just the general affordability pressures of today's economy, whether it's the auto or homeowners insurance, home and auto repair, just overall inflationary impacts. Everything's costing more, and incomes just haven't kept pace with those increases. So when those things happen, they oftentimes create hardships for our members. And the problem, as we've already discussed, is uninsured collateral and how we go about protecting the credit union's balance sheet. The opportunity is we're going to explore the pros and cons of collateral protection options. And a lot of folks don't know that there are a few out there. Collateral protection comes in two insured forms, and I say insured forms because there is a third option out there, which is self-insured. We don't see that happening very often in credit unions, but some credit unions do choose to self-insure. But for today's purposes, we're going to talk about forced place programs and blanket lender single interest programs. And if anyone has questions about self-insured, please ask them. I have limited knowledge, but I'll do the best I can to answer any questions. So basically, forced place, which I'm sure a lot of you folks are familiar with, when a consumer's insurance lapses, the credit union or the lender forced places a policy on the borrower to protect their collateral interest in the loan. When a consumer borrows money from a financial institution, they're agreeing to two primary things. One, they're going to pay the payment, and two, they're going to keep the collateral insured, and they're going to list the financial institution as the loss payee. And when that insurance lapses, the credit union needs to protect itself. The other option that's out there within the collateral protection world is what we call blanket lender single interest. And in those situations, either the borrower purchases or the credit union places on each loan a small premium that covers the credit union. And in both of these situations, the only insured is the credit union. There's generally not any protection for the consumer. What's the impact of rising auto insurance nationally to premiums both in forced place and LSI? With this 20 to 26% national increase in 24 and continued elevations in 25, it's making coverage unaffordable for many borrowers. And as premiums rise, insurance lapse frequency increases, which directly increases forced placements. These premiums themselves are often $2,000 to $3,000 annually per vehicle, which far exceeds the standard market policies and compounding affordability stresses. And as a result, forced place CPI magnifies the very affordability problem that caused the lapse, increasing delinquency and default risk. Adversely, Blanket LSI decouples collateral protection from borrower insurance affordability, insulating the credit union when members drop coverage due to cost. Each closed loan, as I mentioned, has an applicable blanket policy associated to it, and because the coverage is already in place, rising lapse rates do not trigger sudden borrower increases, and that avoids the payment shock that they see otherwise. So as a result, blanket LSI absorbs macro insurance volatility at the portfolio level rather than pushing it into a distress or onto distressed borrowers. And we're certainly seeing that happen more and more. The effect on delinquency and charge-offs. With forced place, these premiums are added to the loan balances on a monthly or totally on the annual premium or in monthly payments. The results in increased delinquency probability, raises repossession frequency, and it inflates deficiency balances at charge-offs. We had a situation where we saw the credit union case study showed material charge-offs of forced place premiums themselves, which negatively impacts the yield and allowance for loan loss calculations. Under the blanket LSI, by avoiding borrower level premium spikes, blanket LSI reduces the payment shock, lowers tipping point delinquency, and it improves recovery predictability on uninsured losses, and those losses become predictable. I'll take a pause to see if there's any questions out there.
None in the chat right now, Dan.
Okay, thank you.
Mhm.
The member experience and reputation risk. And even though NCUA's removed reputation risk from the CAMEL rating, I think it's something every credit union should still be looking at. With forced place CBI, it's consistently cited as a top source of member complaints due to surprise charges, confusing coverage explanations. There's a perception of forced insurance during a hardship. And in a high inflation environment, which we've realized the last several years, these complaints increases more members lapse unintentionally. With a blanket LSI program, it's largely invisible to compliant and non-compliant borrowers, does not penalize struggling members at the moment of the lapse. This LSI supports the credit union mission of people helping people while it still protects the balance sheet. Regulatory and compliance considerations. Regulators are increasingly emphasizing that forced play should not function as a revenue generator, and they're scrutinizing it based on commission structures, borrower notification practices, disproportionate borrower impact, and rising placements raise aggregate exposure, especially in consumer-friendly states such as the state of Maine, where I live. And blanket LSI is generally viewed as a risk transfer mechanism, not a borrower penalty. And it reduces borrower billing activity, lowers UDAP complaints, and reputational risk. For those of you that aren't familiar with the UDAP acronym, it stands for unfair, deceptive, abusive acts or practices, and that's pretty much eliminated on our blanket program. What's the cost predictability for credit unions under these two programs? With forced place, it appears to be pay as you go, but there's an increase in operational burden with loan modifications, both adding premiums or removing premiums when a member proves they have insurance, and the staff fielding member communications. In a few minutes, we'll get to a slide where I'm going to actually read some consumer complaints where it talks about that member communication. And it produces hidden charge-offs when borrowers default. Depending upon the policies that the credit union have with their carriers, there's oftentimes a stop gap limit, and any losses over that, the credit union has to charge those premiums off. So it's, for a lot of folks, it's a hidden charge. With LSI, it converts uninsured collateral risk into a fixed or forecastable portfolio expense. It's got cleaner budgeting and ALM modeling, and operationally advantageous during periods of insurance market instability, as we've just seen over the past few years. So, as our CEO says, she likes to use a little bit of eye candy. So I'm going to take a minute, and it might be painstaking for me to read these, but I'm going to go through them because it really it points out some good differentiators between the two programs. So the question, how do these handle rising insurance premiums? Well, with forced placed, they don't. With blanket LSI, it does. Increases borrower payment stress, definitely with forced placed, but virtually non-existent for blanket LSI. Predictable credit union expenses, they're not with forced placed, but they are with blanket. And member-friendly and inflationary periods, they're not with forced placed, but they definitely are with a blanket LSI program. And what's the regulatory risk with these two programs? It's definitely higher with a forced placed program, and it's lower with LSI. And what's the strategic fit over the 2025 and 2026? It's definitely a defensive posture with forced place, where it's a proactive approach utilizing blanket. A little bit more here. This is the traffic light view with red light, green light, and yellow to pause. What's the regulatory assessment? It's high with force placed and it's low with LSI. What's the reputational risk between the two? It's high with force placed and it's low with blanket. And we'll see this in one of the consumer complaints in a minute. Credit and loss severity. It's medium to high under force placed, but it's definitely lower under LSI because it's predictable. And operationally, it's very high with force placed programs, and it's relatively low under the blanket LSI. And strategic alignment with credit unions, people helping people. It's definitely weak under a force placed program, where it's definitely strong under the blanket LSI. I'm going to hit the pause button again. Any questions or thoughts? Okay. Consumer complaints. I'm sure this is going to be hard for you folks to see, so I'm actually going to go ahead and read through some of these. And there are 3 complaints. They're all with the Consumer Protection Bureau, and we'll chat about NCUA's complaint process as well. So this first complaint came in, and we took out the names of the credit unions. If anybody wants to look at these complaints, you can actually go to the CFPB's website, and they have a consumer complaint search item where you can go in and look to see if your individual credit union may have some complaints that you weren't even aware of, but they do exist out there. So this first complaint came out of Texas back in February of 2024. And I'm going to take a sip of water real quick to wet my whistle. On X date, ABC Credit Union imposed a $4,400 fee to my automotive loan for force-placed insurance. Accordingly, my monthly payment went from $1,100 to $1,500. I reached out to the credit union and found that it was because they didn't have proof of insurance. I showed the credit union that I do indeed have viable insurance and had this viable insurance during the period when I was charged the force-placed fee. I also had viable insurance the entire duration of owning the car, but the credit union did not ever communicate to me at any point that they needed proof of insurance, whether by mail, email, phone call, text, or otherwise. They simply assessed the fee and did not even notify me about that fee, and I have not received reimbursement of any kind as of date. So that's the first one. Second one, complaint was from July of 2023 in the state of Utah. I purchased a car on X date with financing arranged by the auto dealer with XYZ Credit Union. I also insured the vehicle with X and provided the proof of insurance to the dealer and the credit union. On X date, the credit union added $6,200 to my account balance for collateral insurance coverage, despite full insurance coverage being in force with the credit union or with the insurance company. They failed to provide any notice to me regarding the purchase of the insurance and in addition of the premium to my loan balance. The collateral insurance charge is nearly 8 times the cost of my insurance with my provider and represents more than 15% of the cost of the car. I learned of this a year after it occurred, after chasing down the credit union to provide me online access credentials so I could look at my account. Since then, in multiple attempts to amicably resolve this, I have spent hours on hold with XYZ credit union agents, having been told twice that supervisors will call me back, and they didn't. And I was sent to a credit union office that turned out not to even be staffed, and have tried to resolve it through serial email communications. Their efforts collectively represent a tireless pattern of obfuscation and misdirection to reap a windfall on an invalid insurance charge. I mentioned a little bit earlier in one of the pros and cons the administrative burden that goes along with the forced place program, and this complaint certainly speaks to that, with the consumer having spent hours on hold with credit union staff. All right, this is a little bit longer one. This goes back to 2021, almost into 2022, with a consumer in Georgia. I have submitted numerous requests, made numerous phone calls, and submitted documents to X Credit Union to correct the late credit reporting status on my credit file. I have also disputed the incorrect reporting with each credit bureau, and as of today, still not corrected. This has been going on since X date of this year. The credit union had a collateral protection insurance added to my current auto loan, which also took me making numbers of complaint calls, document submissions to have it removed. The force placed CPI is XYZ's credit union's excuse for my reporting my loan X days late. The force placed insurance has since been refunded, and the actual refund date was the same as the start date of the force placed premium. I am submitting a screenshot which shows the dates were the same. However, I noticed today the notes have been changed. Why manipulate dates and amounts, etc., if you are correct in your records? I was told by an associate at the credit union that all which occurred during the time of the incorrect forced place would eventually reflect accurately as before the forced placed premium was added, as if it was never added. This has not happened. Again, the forced placed insurance was refunded, but my account is still reporting X days late for the 3 credit bureaus. Only recently had my account been late due to unforeseen family circumstances, but it has never been X days late. As I stated, I only recently was late, and I have had this loan since X of X with no previous issues. This mishap with the credit union is affecting my livelihood and career. As I am military and are due for my background clearance review, and this late reporting, which is in error, will affect my potential clearance level and other potential credit offers. The X of my clearance are things no lender should be permitted to put their consumers through. This part of this ordeal is totally unforgiving and unrepairable. This lender-borrower relationship is beyond over, and I will share the entire negative experience with my military community, family, and friends. Certainly unfortunate, and like I said, even though reputation risk is no longer part of that CAMEL rating, I think we owe it to consumers to try to act differently. I'll hit pause. Emily, do we have anything?
No questions, Dan. You are just nailing it. If
Okay.
anyone does have any questions, please go ahead and put those in the chat. Thank you.
Thanks, Emily. So where are complaints handled for most credit unions that don't fall over that $10 billion limit for the CFPB? Credit unions that have or consumers that have complaints for those credit unions, those are going to be filed at the NCUA's Consumer Assistance Center, CAC. And the CAC receives complaints on numerous different topics, whether it's auto loan, forced placed insurance, unfair loan servicing practices, transactional issues, deposit issues. Those are all filed with NCUA there. And once a consumer files a complaint with the CAC, the credit union has 60 days to resolve those complaints before any NCUA intervention. And there's a link here, which is live on mine. I know this will be recorded, but that link actually goes out to the NCUA site for complaints. Ooh. So in conclusion, under today's auto insurance cost pressures, forced place programs, they still protect collateral and they're used heavily, but at a growing cost to members' portfolios and reputations. Where blanket lender single interest is increasingly viewed by credit unions as a stabilizing alternative that aligns better with persistent insurance inflations that we've seen, elevated lapses and delinquencies, heightened regulatory scrutiny, and more importantly, the member-driven member protection. So here we are, 25 minutes in for questions and some answers or thoughts regarding the two programs.
Hey, Dan, I'll jump in. I do have, we talked a little before, and just in being in credit union land for so long, there was some class action lawsuits around this over the past few years, wasn't there?
There have been, yeah. CFPB, prior to having kind of their authority pulled under the current administration, they were taking a very hard look at how some of these programs are placed. If anybody wants to reach out to me after the fact, I actually have those lawsuits saved. Some of them are pretty egregious. One of them, the lender and the provider had a 50% error rate in premiums they were placing. So pretty egregious. And
Yeah.
we're not talking about 500 or 1,000 people. We're talking about millions.
Yeah. And they do that under UDAP, or they do it under something else?
That definitely fell under the UDAP race.
Yeah.
Yeah, it was pretty egregious.
All right. Give it a few. Any questions? Any last call for questions for anyone?
I have a question for folks out there. Maybe you can do a show of hands with Emily. How many folks on the call at the credit union level were aware that there was an alternative to force placed with a blanket LSI? Just curious. Wish we had one of those polling options.
Yeah, we'll have to add it to the next one for sure.
Okay, well, it appears that
All
a lot
right.
of folks are aware of it, so that's good to know. So
Well,
Randy, if anybody wants to share this presentation with folks within their organizations, will this be available for them to do so?
It is. We'll get the recording. It usually takes, I'll get it within the next 24 hours from Zoom, and then we'll send it out to everybody on the email that was registered for this webinar.
Great.
Yeah, they're welcome to share. They'll also have it on our website as well if you want to go to it and get it there, or point people there. But Dan, thanks so much. Wonderful information, super critical for credit unions, all part of the member-driven mission. And thank you to everyone for joining us. If you have any questions, like Dan said, please reach out to Dan and his team, or myself and my team at any time. And have a great day, everyone.
Thanks so much.